Well, I actually. Oh, okay.
That's all right. You can still talk with pretty casual, even though it's recorded. But yeah, I'll go through. I'll just go through the basic concept of what a fair value gap is tonight, and we'll probably talk about other stuff as well. But we'll just go through, exactly what is a fair value gap and the basic idea behind how we use that. And then on the next lesson, we'll talk about a few more different concepts and fine tune exactly how we use that in a trading, in trading logic or a trading plan. I call everything. I don't call my trading plans now. I call them trading logic because that's my trading logic's a section of my code when I'm creating an EA, which is the same as a trading plan but in code. All right, so a fair value gap. Let me just find a good example. Like everything else in trading, it can be found on all different time frames. I'll just use this one for now, and then I'll bring in another example. So a fair value gap is what would you call it? It's a three candle pattern. That's not the word I wanted. Yeah, it's a three candle pattern, but it sort of shows or designates what they call a displacement in the market. It's just shows where there's a gap where the market's going to come back to. It can either be a bullish fair value gap or a bearish fair value gap. But in this example, we're going to use this green candle, this red one, and then this red one. That'll be our 1, 2, 3 candles. And what we're looking for is a gap between the bottom of the first candle and the top of the third candle. So in this example, we've got the bottom of that green candle and the top of the third red candle. Now you'll get slightly different interpretations of it. I know some people just use the body of the candle, not the wicks. But in my opinion, you got to include the wicks because I'll get into why later. But so the distance, the gap between there would be what we would call a fair value gap. And I tend to just draw them in with a little zone like that so that I know where they are. This one's obviously because the middle candle is a bearish candle, a red candle, this is a bearish fair value gap. Now, what it means is that there's a gap in the market there. I'm probably going to get Des to take you through why this happens. But essentially, the big movers and shakers in the world of Forex trading, they have both buy and sell orders in this gap here. Well, not necessarily just this gap, but they because they do a lot of hedging type trades. So obviously, if they've got sell orders here, as the market comes down like it has, they can make profit on that. But they still have buy orders here as well. So there's a 100% chance, or at least 99.9% chance that the market is going to come back to where they have those buy orders so that they can close them out at break even or a small profit. So we're talking about people that are placing, billion-dollar trades. So if the market doesn't come back to here, those people are going to lose billions of dollars. And they don't have billions of dollars because they lose it. They have billions of dollars because they keep making it. And so that's the basic idea behind it. It's not much more technical than that. Obviously, there's more to it when we start talking order blocks and different, slightly different setups and everything. But does that sort of make sense? That if, I mean, that obviously makes sense if the, you know, somebody's got a 10 or a $20 billion trade here and it's a buy order. Obviously, only people with billion-dollar trades are the major institutions, the banks and big hedge funds and that, the people that can manipulate the market. I don't really like the term manipulate the market because they're just doing what they do. You know, they just happen to have the money to do it a bit better than a lot of people. And it's the only people that really call it manipulating the market, in my opinion, are those that don't understand it. If we understand what they're doing, then we can, use that to our advantage. So, obviously, let me know if this doesn't make sense, but if somebody's got a $10 billion or several $10 billion trades here, there's a pretty good, and then the market gets down to here, there's a pretty good chance they're going to push the market back up to here so they don't lose billions of dollars. That should be pretty obvious, I think. Just speak up, guys, if you agree or disagree or want more clarification. But at some stage, the market is going to come up to here. And like just here, the market's come up to here. And this is where ideas behind fair value gaps will change as well. I have heard it said, and I don't agree with this though, that what they say is that when the market, even if it's just a wick, comes into the fair value gap, that mitigates the fair value gap and it doesn't mean anything now. And then you'll hear them say that if it closes in the fair value gap, that's mitigated the fair value gap. And by mitigated, I mean cancelled it out. It's no longer a fair value gap. But in my opinion, or I don't think it's my opinion, but my opinion's right. What this candle's done is it's mitigated a portion of the fair value gap. So now the fair value gap's only this big. I don't consider the fair value gap completely mitigated until the wick gets to the top of the fair value gap. But we've mitigated this bit. And so what you'll find happens is that we've gone into the fair value gap and then the market's coming down. And now this is a 4-hour time frame, so the fair value gap's quite a large gap pip-wise. And once it comes in here, what you're going to look for is confirmation that the market's going to come down. We still want to trade with the trend or with the higher time frame trend, and this is a 4-hour time frame. So, and the 4-hour time frame's going down. So we want to do sell orders. So once the market comes back up into this bearish fair value gap, then I look on the smaller time frames to see that the market structure's changed. And once it does change and starts going down, you can start doing your sell orders. But you also have to be aware of this, the fact that we haven't fully mitigated this fair value gap. So you can sort of, just be aware that the market may also decide to come back and finish mitigating it. It also may come down a lot further before it comes up and fully mitigates it. But at some stage, it will fully mitigate it. But, and I've done this plenty of times, the market partially mitigates that order block, that fair value gap we had. And then you can trade down here. And just to put that into perspective, so let's say the market, well, let's do it this way. Hang on. I just put a marker there so I can find this on a smaller time frame. Now let's jump down to 5-minute time frame. Let me try and find my line now. There it is. So it didn't look like there was very much room to do sell orders. But now that we're down on the 5-minute, and I do tend to like to do this even on the 1-minute. So the market did come right down to here. Before it then went up and finished mitigating. So from the time the market partially mitigated until we realised that, and then to get full confirmation that the market structure has changed, we need to form a lower high and a lower low. Okay, so right about here, we've sort of confirmed that market structure had changed. So you could start looking to do sell orders. And as you can see, it was a nice gradual run down. And then it sort of plateaued out, but did eventually come right down to that green line. So from where we could have started trading down to that green line, oops. Is still 35 pips. So more than enough room to be trading on the lower time frames. And because and we're only on the 5-minute time frame here. So if you're on the 1-minute time frame, you could even do tighter trades. But you know, if we placed a trade here, oops, I got the wrong one. If we placed a trade here when the market structure had changed and we put the stop loss above this high point, and we managed to trade that all the way down as far as the market went, that's a 4-to-1 risk to a 1-to-4 risk to reward ratio. So that's still a great trade. And as per that sort of order flow strategy that we've had a bit of a look at, you know, when the market broke structure again, we could have taken another trade, which could have potentially gone this far down, and it would have been a 3.3, a 1-to-1, 1 to 3.3 risk to reward. And then we could have got into another trade about there. And now we're getting down to, you know, a bit less than a 1-to-2 risk to reward. But, you know, we definitely could have got 3 nice trades in there and played them all out down to at least 2-to-1 risk to rewards. So even though it didn't look like very much room to be placing trades when we're on the 4-hour, where's all my pictures gone now? Okay. So even like originally our order block was here. When we partially mitigated it, we still had plenty of room down to as low as the market went just here. So from here down to here was a little section we were looking at on the 5-minute time frame, and plenty of room for 3 really good trades just in that little drop there. And but then, you know, once the market structure changed and started going up again, then we'd stop trading, because the reason we stopped trading is because the market is still going down. So we want to keep following the overall trend on the 4 hour, which is coming down. And then the market here, it's fully wicked through the whole order block. So now we're going to say that that's fully cancelled out and mitigated. But then, then we can start doing trades all the way down to here again, which is even a bigger trend down from here. Trending down to here is a much bigger trend down than what we had originally. So, there'll be several more potentially good trades there as well. And even though in hindsight we could have done it again and again, we wouldn't, because we wouldn't have done it based off a fair value gap, because now there is no fair value gap there because we've fully mitigated it. Does that mostly all make sense, guys?
I'm not sure yet.
So all we're doing is identifying. Well, there's going to be a lot more to it, but for the moment, we're just trying to keep it simple and just talk about a fair value gap. A fair value gap, would you agree, is something that's extremely easy to identify? It's just 3 candles with a gap between the top one and the first one and the third one.
Mm-hmm.
That's, in my opinion, that's something that's extremely as easy as any candle pattern to identify. But there's very close to 100% chance that the market is going, the market comes down below it, the market is going to come back into that fair value gap. There's really no doubt about the fact if you've identified a proper fair value gap, the market will come back into it. Once it does, then you look for other indications. The main one being market structure on a smaller time frame starts coming down, and you can start trading down. All we're doing then is trading with the trend. It's as simple as that. The only reason we're using the fair value gap is because once it mitigates it, then the market tends to drop sharply out of that fair value gap again. Now, because this is a 4 hour fair value gap, a 4 hour fair value gap, it's that's like a 50 pip gap or more in there. But if we have a look at this one where it's finished fully mitigating it from there down to as far as it came again, now that's an 85 pip drop just there. So big potential for quite a few decent trades on the way down.
So the key point then is, out of the fair value gap, once it's either mitigated or partly mitigated that, you're looking at it to sharply drop after that point. And
Correct.
That's why you're doing the short.
Yes. We're still trading with the trend, our friends and all that. But the thing is, if you were just trading with the trend, you might see the market structure change here. In this case, it would have been good to do a sell, but it may have just kept going up. If it does actually mitigate a fair value block and the market structure changes, then it can drop a long way down after that. Now, we're going to bring more facets into it as well, so that it's much more precise than just that. And one of the ways we make it more precise is to look at fair value gaps on the smaller time frames as well. So if we just drop down to let me just put this fair value gap back in.
Just quickly, what are you using to determine the trend there? Is you just looking at the chart overall? You're not looking at that. Is that a moving average? Obviously not using that.
Well, that is the moving average that I do use. That's the 58 moving average that I do use in my EAs to determine trend. That's why I just have it on there. But really, we're just looking at the fact that, that's obviously a downtrend on the 4 hour.
Yep.
So however you would normally determine a downtrend. And if we look at this is a very obvious downtrend, downtrends, because we've got highs, a lower high, lower high, lower high. But then we've just formed just a a normal high, not a lower high.
Yeah.
But the reason for that is because it came all the way up there to mitigate that 4-hour fair value gap. A lot of the time, we'd start to, and we still would take it into consideration that because we haven't formed a lower high, that the market structure may have changed. When you're just sort of trading market structure and you got lower highs, and lower high. Now we've formed a higher high, but we haven't really gone above. We've gone above this lower high, but not above this high here, and that's just because it's mitigating a fair value gap. And I guess we'll see what the
Yeah, I'm
market does
starting to
now.
get the idea. Starting to get the idea. Very interesting.
And so then we can start to, like at the moment where the market is now, we've already mitigated this for fair value gap. So it's not playing a part in any of our calculations now because we have fully mitigated it there. But if we then drop down to the 1 hour time frame, and let's see what we've got here. All right, so
what are you looking for? Another fair value gap
looking
now?
for fair value gaps on the 1 hour now, and so here and here, this is a fair value gap between that green candle's wick and that one there. So
Sorry,
that's
whereabouts?
just right here at the
right.
start. So
So-
between the wick of this one, because now we're looking at a bullish fair value gap this time though, because it's got the middle candle is green.
So the wick of that small green candle.
Yeah, so we've got I'll zoom it in a bit more. So we've got the wick of this green one up to the wick of this green one.
Oh, yep.
But then what I do is it was partially mitigated on this candle here. So, and since this happened, there has been, the market's never come back down into this one here. So this is still an
And you're
active
saying
fair value gap.
You're saying it will come back down in there yet because there's trades that these big traders have got to take out yet.
Yeah, there are other factors involved, but just trying to keep it just about fair value gaps at the moment. And, the one thing you don't know is when it will come back into the fair value gap. It could be hours, days, months, and depending, particularly if we're talking high time frame trends, high time frame fair value gaps, it can be quite a long time by the time the market drops way below it and does come back into it, but it still does. So if we were, we've fully mitigated this order block back here before, but the overall trend on that 4 hour is still down. So, you would sort of expect that it's going to come down into this order block. Sometimes, there can be multiple order blocks, so there's a little one
And
just there.
can you mark the order blocks on your charts so that you can keep an eye on it for days or weeks or however long?
I just did.
Oh, right, that's it there. Sorry, I'm in the dark here and I've only got this one little screen.
No.
Right.
So yeah, I tend to label everything as well. So I just call this one a 1 hour fair value gap. So that, when I'm back here where the market is, I can just clearly and use different colors as well. But
yeah,
I know that's a 1 hour fair value gap. But because this wasn't right at the bottom of the market, there's not really there's not a fair value gap here anywhere because all of these wicks are overlapping. So that is really the only fair value gap before the bottom of the market here. So if I just jump back to the 4 hour. And you know how we were saying it's a nice downtrend. We've all got lower highs all the way down. But just now we've actually formed a higher high to mitigate that 4 hour fair value gap. So, you know, the market may be changing structure and starting to go up. But I'd say there'd be no doubt that the market would drop down in here, just mitigate this last little order block. And then if it was going to start an uptrend, like let's assume that this is the start of an uptrend, the market's still going to duck back down here before continuing that uptrend. So what we're talking about here isn't really a lot different to your basic technical analysis, you know, trading with the trend, working out, you know, where the market's going to come to before it continues up and all of that. It's just that having a fair value gap and understanding what that means as far as big trades, big money left on the table here, means that the market will come to here before going up. Of course, it may go up a long way before it comes back down into here, but at some stages it will. So all I tend to do, like I would pay more attention to the higher time frame fair value gaps than the lower time frame ones. Generally, I always have the 4 hours, the 1 hour, and the 15 minutes all drawn on here so that I know where they are. And then it's just a matter of, you know, waiting for the market to enter one of the fair value gaps and then seeing what the market does. So, you know, I would place an alert or an alarm somewhere in this, you know, just a little bit into this fair value gap so that it would let me know when it got in here. And then I'd look for it to start an uptrend, the market structure to change on a lower time frame and start coming up, and then you keep trading. And I like that order flow strategy for that because it allows you to stack trades safely without increasing your risk. And that's all, you know, like a lot of people would, you know, work out where support was, you know, like, I guess this is old school type thinking, but, you know, work out, you know, like you might say that support's here because that's where the market bounced. So if the market got down to here, you'd be looking to do a buy order. You know, if you saw the market, you know, like I don't really trade like this anymore, but if the market got down to support, then you would look for, you know, the market structure on a lower time frame to change, and you'd look to take out buy orders. It's very, very similar to what we're doing here now, except that we've got a much more precise reason for why the market's not coming all the way down here. Of course, it could, but we know that it's definitely going to come to here. We don't know for a fact that the market will come down to what we would call support line here, but we do know that it will come to here. When the market actually goes through a fair value gap and mitigates it, that doesn't necessarily guarantee that then it's going to bounce and shoot right up. It may just smash through it, and then it might go right way down here somewhere to where there's a higher time frame fair value gap. There might be a daily fair value gap way down here further. So it might just smash through here, mitigate all that, which is fine for those the big movers and shakers because the market still goes through here and they can close out their sell orders as profit. But then depending on, you know, what's going on, the market then might just keep going down, and that's fine for them. They just make profit on those sell orders. They don't have any more money left on the table there. Because when, you know, imagine they've got back here where that fair value gap started, they had buy orders and sell orders. When the market moved up to here, they closed their buy orders and made profit. Their sell orders are in drawdown. So however long it takes, eventually the market gets to here so they can make profit on those sell orders. They may just sort of break even or take a small profit, or depending on the plan or what the market's doing, the market may just shoot past it and they make big profit on those sell orders. But the key point to remember is that where the fair value gap is here, they have buy orders and they have sell orders in this fair value gap. The market moved down, they made big profit on the sell orders. They made some profit on the buy orders. Okay, that fair value gap's now gone. And those movers and shakers have made money on their sells, and mostly on their sells, a little bit on their buys. And now this is where the market's at. So all it really is a more precise way of knowing where the market will come to. You still don't know when, but you know that doesn't matter. You just wait for it to get there and see what happens.
So is a fair value gap the same as an order block?
No, but
Okay.
I wasn't going to get into order blocks. I'm going to get Des to talk about them for us as well.
Yep,
But
that's fine.
an order block isn't what's the word? You know, you need the fair value, like the order block would be here. And in this case, on the opposite way, you got the fair value gap, and that's the order block there. You need the fair value gap to be there as well before the order block is fully verified.
Okay.
We'll get into that more later as well.
Yeah.
Let me see if I've got a chart that's a bit more organized. I thought I might have had one with more drawings on it. Doesn't look like it. You can see here I've had probably a 1 hour fair value gap and some 15, those little ones there are 15-minute ones, and I've been working that out there. I must have deleted everything ready to draw it in for you, but yeah, I would just start on the daily if I was just charting up from scratch, and you know I'd find all the fair value gaps and I'd draw them in. So all I'm really interested, so the market's here. All I'm really interested in at the moment is that any fair value gaps I can find above it, up until the top of the market, and any fair value gaps I can find, probably not to there, but all the way down to here. And I would draw them in. That'd be my daily ones. And then I'd drop down to the 4 hour time frame, and I'd just do the same. Fine, you know, so we've already identified that one was mitigated. So I'm just going to work my way up the market here and try and find more fair value gaps. So there's a fair value gap between there and there. Just, you know, there's between those three candles just there, form a fair value gap there. You know, just tiny bit got mitigated here, but the market hasn't gone back up to there yet, so it's going to go to there at some stage. And up here, we would find a few more little bits as well. And right at the top here of the market, there is no fair value gaps there. But, you know, we've identified a couple of 4 hour fair value gaps there. And we've got the 1 hour one below us. I'll just jump down onto the 1 hour time frame again. We've got the 1 hour fair value gap below us. Let's try and find one above us. Just with a little bit of practice, they are very, very easy to identify. Although there's really no 1 hour fair value gaps until we get up to the 4 hour one here. So There's no need to find a 4 hour, a 1 hour one there. And I do like 15-minute ones as well. And the way you can really fine tune it is you can find a 15-minute fair value gap in amongst a 1 hour one or a 4 hour one. And then when you bring in order blocks and the order flow strategy, you can end up with really, really tight stop losses. So, you might only have a 5. I generally can get it down to a 5 to 10 pip stop loss, and aiming for a 20 pip take profit, which is 4 or 5 to 1 risk to reward, which I think's quite good. But
Yep.
much larger risk to rewards can also be found as well. If you can keep your stop loss at 5 pips and take 50 pips of profit, that's a 10 to 1 risk to reward. And the market, especially if we're looking at 4 hour time frame, the market could easily drop 200 pips over the course of time. And then if you had a 5 pip stop loss, we'd be looking at a 40 to 1 risk to reward.
Wow.
Which means if you were risking 1% of your account to potentially make 40% profit. Of course, lots of things can go wrong before you take 40% profit. You see yourself in 3 or 4% profit and you just want to take it. And that's the damned if you do, damned if you don't scenario, of course, with trading, is that the potential to take really big profits is there, but in doing so, sometimes you miss out on a decent profit, aiming for a bigger one. So I always like to take some profit off the table. So if I was aiming for a 10 to 1 risk to reward, I'm probably going to, close out a quarter of my trade at, 4 to 1, and, close out another quarter at 6 to 1. And by the time it gets all the way through to 10 to 1, I might only have a quarter of my trade left. But I depends how certain you are of the trade, of course, but I find it's always a smart thing to do to close out at least portions of your trade as you go along, particularly if you're coming to another point of interest where the market may turn around again. And obviously, if you're using that order flow strategy, if the market mitigated a fair value gap and then the market structure change and you're using that order flow strategy on the lower time frames, when it stops forming lower highs, it starts doing higher highs again. Yeah, obviously you stop trading down then and take whatever profit you've got. It's not unlike any other trade at that stage. If you might put your take profit here because there's a fair value gap here. You wouldn't put your take profit here because the market's more than likely going to bounce here. So you work out, how far you think the market could go, and that's where your take profit goes just a little bit less than that. But there may be points of interest along the way, and you may notice the market structure change for some reason you haven't identified. But obviously that's a good place and a good reason to take all or at least a good portion of your profit off the table, because there's nothing worse than being in 5% of profit and ended up taking hardly anything in the end. Anyway, that's pretty much it for fair value gaps, guys. I'm going to stop talking now, but if you've got a few questions, we can go through that. And other than that, we will continue this discussion next time.
Thank you, Les.
No worries. Well, if obviously we've got our chat group and everything there, so
yeah, I think I'll have a lot of questions. I really want to look into this, but yeah, not now.
No, not now, but we've got the replay there and we can go through it. Like with any of the lessons, you can't beat just jumping on TradingView and going through and identifying them, drawing them in, label them like I did this one down here, so you know what they are. Preferably have a different color for dailies, 4 hours, 1 hours, but also label so you know what they are. And then, like any new strategy, just watch them play out. But what's really opens your eyes is once you identify and draw in these fair value gaps, then watch what happens. Like we saw what happened with this one here. It tapped it out, and then the market kept going down again. But draw this up on this one or another chart and watch, and just might take a short time or a long time, but we'll just watch and see when does it enter this 1 hour fair value gap. When does it get up to this one? What happens when it does? And you can just start to see new patterns in the market that you've never really seen before because you weren't looking in that direction, because you didn't know what a fair value gap was. Like for here, we've got a fair value gap, but if you didn't know what a fair value gap is, the market might come to here and then turn around, and you would have no idea why.
Yeah.
Also, what you used to call a support or resistance line, draw them in as well, and then go back to where it crosses the market and have a look. There's probably a fair value gap or an order block there. So it's still a support or resistance line, but you'll probably find it does line up with smart money concepts as well. So before we'd
Very interesting.
identify a resistance line simply because the market had bounced near or close to it a few times. Now what we'll find is that there was an order block and a fair value gap, and the couple of times that it bounced was because it partially mitigated, a bit more mitigated, and then fully mitigated, and then dropped down. So the old saying that a resistance line is stronger the more time it bounces is basically wrong, because if it's bounced a few times off it, it's probably cleared out all of those orders that were in place, and then the market can continue on its merry way, whichever way that happened to be. Right, I'll leave it with you guys. I'm going to go and do the dinner thing.
Thank you very much, Les.
Thanks,
I'll
Les.
talk to you later. See you, Kev.
Okay, bye.
Have a good night.